The outlook for the economy in 2024 does not look good. On top of what looks to be a giant housing bubble and an affordability crisis in the residential real estate market, there's also a looming crisis in commercial real estate that is going to cause a lot of banks to fail. As a real estate investor who invests in commercial real estate and understands how these types of loans work, the things that I'm seeing about these banks and the kind of exposure that they have to these bad loans gives me cause for concern. Now, there's been a steady flow of research on exactly how much exposure these banks have to these bad loans in commercial real estate over the past year, and it doesn't seem to be getting as much attention as it deserves. At the end of last year, in December of 2023, there was a research paper done by the National Bureau of Economic Research in regards to these bad loans and how they might affect banks. And using loan data, they found that after recent declines in property values following higher interest rates, and the adoption of the hybrid working patterns, about 14% of all loans and 44% of office loans appear to be in negative equity where their current property values are less than the outstanding loan balances. The article goes on to say a 10% default rate on CRE loans, that's commercial real estate loans, or a range close to what we saw in the Great Recession on the lower end, would result in about $80 billion of additional bank losses. It also says that if CRE loan distress would have manifested itself in early 2022, when interest rates were low, not a single bank would fail, even under the most pessimistic scenario. However, after more than $2 trillion decline in bank asset values following the interest rate hikes of 2022, an additional 231 banks with assets of $1 trillion would have their marked market value of assets below the value of their equity liabilities. So why exactly is this a big deal? Well, in commercial real estate, your loans are only fixed for a certain amount of time. It's not like residential real estate where you have a fixed term over 30 years typically, and it doesn't change over that period of 30 years. In commercial real estate, you typically have a fixed term of 3, 5, 7, or even sometimes 10 years where your interest rate can be fixed. And it's typically amortized. The payment schedule is scheduled as if it is over a 20-year period. But after that 3, 5, 7, or 10 years, you typically have to get your loan refinanced, or you have an adjustment to the market rate, the current market rate at the time of that renewal, at the time that that term comes due. So say for instance, I had it built into my loan that my term would just adjust to the current market rate. Well, let's say I had a 4% interest rate 3 years ago, 5 years ago. If my term came due now and I had to adjust to the current market rate, it would be somewhere near 8% or even higher, which drastically reduces the amount of cash flow that I will be receiving from that property. And even in some cases, in the worst cases, it can actually put you into negative cash flow situations where you don't even make enough from the property in order to pay for all your liabilities. The second thing that can happen if you don't have it built into your loan where the interest rate automatically adjusts to the current market rate is a bank can just actually require you to make a balloon payment. So once that term comes due, you would typically go to another bank and refinance your property and pay it off with your originating bank. So now the new bank is going to hold your note. Now your originating bank can always refinance it, and a lot of times that does happen, but I don't believe that that is actually an option for these banks under the current market conditions. So two things. You can have it built into your loan that it automatically adjusts, or you can be required to make a balloon payment. So why exactly is this a problem with these commercial real estate loans? Well, the value of the assets that are backing these loans has drastically declined. Which leads us to our next question, why have values declined? Well, in the case of office real estate loans, nobody is showing up to the office. And that means that you have less income, less revenue coming in. So the valuation of your property has drastically declined. The main driver for value in commercial real estate is the income that it can produce. So your property value drops below the amount that you owe on the loan. And after that term is up, no matter which scenario it is, an adjustment of your rate or a balloon payment, you're not able to refinance the way you traditionally would. The other problem is, even if you have a lot of equity in the property, say you only owe 65% of the total current value of that property on that loan, and your term is coming due and you go to another bank to refinance that note. They may not even want to refinance you because it is a very risky asset right now. Now, you might get lucky and your originating bank might want to work with you, but in these current market conditions, that is highly unlikely. And I actually had something similar to this happen to me over the course of the last year. I actually did a video on it, you can check it out. I had a bank call one of my lines of credit due. It was a second position line of credit on a multifamily property, and it was only about 55% loan to value. Well, this revolving line of credit came due, and the bank just refused to refinance that note. They actually wanted me to take it to another bank because all banks are basically trying to be risk averse right now. And these are the kind of scenarios where you hear stories about the borrowers handing the keys back to the bank. Basically, they just work out a deal with the bank, and the bank takes back the asset, and the borrower just walks away because they have no other choice. No other banks are going to finance that property, and the bank that they have the note with is not going to finance the property. So the banks take it back, and now it's their problem. And so you might be asking yourself, don't banks actually have reserves for this kind of situation? Don't they have money set aside somewhere in order to cover these losses? Well, the short answer would be yes, but is not matched dollar for dollar against those loans. Traditionally, banks would set allowances by loan category and historical loss rates. So say, for example, they might set aside 10% for unsecured loans, like credit cards. But in commercial real estate, they would only set aside 2 or 3% because that's the historical average of defaults for that type of loan. So for commercial real estate, they would set aside 2 or 3% of the total value of those loans as a reserve in case some of them had defaults. But according to some reports, over the last couple years, bad commercial real estate loans have overtaken the loss reserves at the biggest banks. Reserves at some of these banks, according to reporting, has fallen from $1.60 to 90 cents for every dollar of commercial real estate debt. And here's a comparison of what the reserves were in 2022 compared to what they are now in 2023. And at some of these banks, loan delinquencies tied to office, apartment, and other residential buildings has jumped 50%. So with all that, if we go back to that paper by the National Bureau of Economic Research that we touched on at the very beginning of the video, it warned that if only 10% of CRE loans default, it would result in about 80 billion additional bank losses, which could lead to more than 300 smaller regional banks at risk of solvency. Now, these aren't just economists that are coming up with this as some kind of future prediction. This kind of stuff is actually playing out as we speak in real time. Blackstone, one of the largest real estate investors, posted record losses in 2023. They posted a 60% decline in net income, which is tied to investment losses and a decline in those properties' values. And Blackstone isn't the only investment bank to post significant losses. Capital One, JP Morgan, and virtually all the other big name banks struggled with distressed loans over the last year. And they aren't even the ones to be most concerned about. Small regional banks are the most at risk because they hold 67% of all commercial real estate loans. To me, all this signals that it's only a matter of time before the proverbial you-know-what hits the fan. And so I'm making sure that I have as much cash set aside as possible so I don't run into any issue with these banks. And you should too, because there's going to be a lot of opportunities that pop up. And if you're a real estate investor, you want to make sure that you have a lot of cash on hand, a lot of dry powder ready in order to scoop some of those up. Because there was a lot of investors that got in over their head over the last year and a half or so. And if you're not a real estate investor, you still should be taking note of all this because there's going to be a lot more bank failures. And if you have your money in an institution, who knows what the heck could happen? I, for one, had some issues with my banks about a year ago when all those other banks ended up failing, and so I don't want to run into that situation again. So anyways, if you like this video, please like and subscribe. You got any questions, comments, please drop it down below. And as always, thanks for watching. Till next time.